A real AI fund turned $10,000 into $20,732. A plain S&P 500 investment became $29,829. This is the real report card for AI stock picking. Not a backtest, not a chatbot guessing tomorrow's winner. These are live funds that took real money and published results. One fund's best recent year looks great. Its full record tells a harsher story. By the end, you will know exactly where AI helps and where it still fails. The test that actually matters. What would count as proof that AI can predict the market? The cleanest test is not a demo. It is not a screenshot. It is not a model that picked 5 winning stocks. The test is simple. A fund must invest real money. It must live through good markets and bad ones. Then it must show its results beside a cheap index fund. That is why AIEQ matters. AIEQ is the Amplify AI Powered Equity ETF. It launched on October 17, 2017. It runs on the IBM Watson platform. This is not a story about a future system. It is a report card from a fund with years of live results. AIEQ is also useful because its own annual report shows both sides. It shows a recent win. It also shows the longer record. That makes the fund a better test than a bold ad. A one-year result can happen by skill, luck, or a market style that fits the model. A long record tests whether the edge kept working. Think about a weather app. One correct forecast proves little. Hundreds of forecasts across seasons tell you whether the app is useful. Investing works the same way. The market changes. Interest rates change. Leaders change. Fear changes. A system that works in one kind of market may struggle in another. It must also survive its own success. If a model finds a public pattern, other traders can copy it. That can shrink the advantage. A model needs more than a good start. It needs a repeatable edge. That is the standard for this video. No magic claims. No guessing from a few headlines. Just the score over time. And AIEQ's score starts with a number that sounds respectable. Then the benchmark enters the frame. AIEQ's long-term report card. How did the longest-running AI stock-picking ETF do when the whole record is shown? For the period ending September 30, 2025, AIEQ's annualized return since inception was 9.60%. The S&P 500 returned 14.73% annualized over that same period. That gap is more than 5 percentage points each year. It does not sound huge in one sentence. Compounding makes it huge. Start with $10,000. In AIEQ, that grew to about $29,732. In the S&P 500, it grew to about $29,829. The AI fund made money. That point matters. But the simple index produced about $9,097 more from the same starting amount. The 5-year record was worse. AIEQ returned 8.71% annualized. The S&P 500 returned 16.47% annualized. That is a 7.76-point yearly shortfall. In investing, a gap like that can change a retirement plan. Returns are not the only issue. AIEQ's Sharpe ratio was 0.71. The S&P 500's was 0.88. A higher Sharpe ratio means more return for each unit of risk. So AIEQ was not just behind. It also gave investors less reward for the risk taken. Its Sortino ratio told a similar story. AIEQ showed 1.16. The S&P 500 showed 1.37. This is the part hypo N skips. The question is not whether an AI fund can ever make money. The question is whether it beats the alternative enough time. For AIEQ, the published answer is no, but there is one number AIEQ can put in big letters. That number explains why short windows sell so well. The cherry-picked window. If AIEQ trailed for years, why can its marketing still look convincing? Because over the 1 year ending September 30, 2025, AIEQ did beat the index. AIEQ returned 19.68%. The S&P Total Return Index returned 17.60%. That is a real win. It should not be denied or hidden, but it is one window. It sits beside the same fund's 9.60% annualized return since 2017. The S&P 500 posted 14.73% over that longer span. Both statements are true. Only one tells you what happened across the fund's life. This is the cherry-picked window trick. A manager finds the period where the strategy looks strongest. Then the weaker years move off screen. It can happen with humans, AI, and any kind of investing product. The technology does not change the math. When you see a fund beat the market, ask 4 questions. What is the start date? What is the end date? What benchmark did it use? What happened since launch? Then ask one more. Was the money invested before the good period began? A short winning streak is not proof of a durable prediction machine. It is a reason to look deeper. 5 years provide a better clue than 1. Since launch provides an even better clue. Neither guarantees the future, but both cut down the chance of being fooled. The AIEQ report gives a second lesson. Its expense ratio is 0.75%. That fee explains only about 15% of AIEQ's performance gap. About 85% came from the stock-picking decisions themselves, so the weak result cannot be blamed only on fees. The central problem was the actual selection process. One fund falling behind could be an exception. The wider AI fund field gives a more unsettling answer. The AI fund graveyard. What happens when an AI fund fails to keep enough investors or results? Sometimes it closes. AIQ was AIQ's international sibling. It stopped trading on July 28, 2022. It was liquidated the next day, July 29. Then came QRFT, the QRFT AI-enhanced US large-cap ETF. On June 30, 2026, its issuer announced the fund would close and liquidate. QRFT's last trading day was planned for about July 24th. Its liquidation date was planned for about July 24th. That is important because QRFT once had a success story. At its 5th anniversary in May 2024, QRFT had gained 114.2% since inception. It had beaten SPY by 11.7 percentage points. That is the kind of number that can power a powerful sales pitch. But markets do not stop at the best anniversary. Later comparisons showed a 14.6% 5-year QRFT return. The S&P 500 Total Return Index returned 16.6%. Then the fund was scheduled to disappear. The point is not that every closure proves fraud or failure. Funds close for many reasons. But a closure ends the promise of a continuing live record. It also shows why investors should not treat a short winning chart as a final verdict. AIIQ and QRFT are reminders that a fund name can last less time than the marketing around it. Still, calling AI useless would be just as misleading. One related fund shows why the honest answer is harder. The counterpoint AI fans deserve. If some AI funds failed, did any AI-managed strategy actually beat its benchmark? Yes. AMOM's is the QRFT AI-enhanced US large-cap momentum ETF. At its 5th anniversary in May 2024, AMOM's had returned 111.6% since inception. Its benchmark was the iShares MSCI USA Momentum Factor ETF, known as MTUM. AMOM beat it by 34.3 percentage points. That result matters because it blocks an easy but false conclusion. AI is not automatically useless in markets. Some models can find useful patterns. Some systems can add value in a specific market style. Momentum may be one place where a model can help, but one fund's strong period does not prove that AI can reliably predict the whole market. It proves something narrower. It proves that a particular strategy beat a particular benchmark over that period. That is how investment claims should be read. Keep the claim the same size as the evidence. AMOM's result is a counterpoint, not a permission slip for blind faith. A normal investor still needs to ask whether the edge will continue. No model can promise that. This is also why the phrase AI beats the market is too broad. Which AI? Which strategy? Which market? Which years? Against which benchmark? Without those details, the claim is a headline, not evidence. And the fair benchmark is not an imaginary perfect investor. It is the real score of professional stock pickers. AI is competing with a very low bar. If professionals struggle to beat an index, should anyone expect an AI to do it every year? S&P Dow Jones Indices tracks active fund managers in its SPIVA scorecards. In 2025, 79% of active large-cap U.S. equity funds underperformed the S&P 500. It was the 4th worst year in SPIVA's 25-year history. In 2024, 65% of those funds underperformed the S&P 500. Over 15 years through 2024, about 89.5% of active large-cap funds underperformed the index. That is the real hurdle. A regular investor can own a broad index fund. An AI strategy must beat that choice at year costs and risk. Most human professionals cannot do it over long periods. That does not make humans foolish. It shows how hard the job is. Every public fact is watched by investors, analysts, and machines. Every obvious bargain attracts buyers. Every obvious problem attracts sellers. By the time a popular AI tool reads a public headline, many other systems may have read it too. This is not a reason to give up. It is a reason to raise the standard. A model does not earn trust because it uses the word AI. It earns trust through a long-lived, clear record against the right benchmark. AIEQ did not clear that bar over its full history. AMOM gave a strong example in one-factor strategy. QRFT showed how a prior win can fade. Those facts can all exist at once. So where does that leave AI? The answer depends on a distinction most hype skips. Prediction is not processing. What AI can do and what it cannot promise. What is AI actually good for if it cannot reliably call the next market winner? AI can process a mountain of information fast. It can sort filings, compare numbers, flag changes, summarize news, and test many patterns. That is valuable. It can help an investor ask better questions. It can help a research team notice facts that humans may miss. A study from the University of Chicago Booth tested GPT-4 on anonymized financial statements. With chain of thought prompting, it predicted the direction of future earnings changes with 60.35% accuracy. Human analysts reached 52.71% on one-month forecasts. They reached 55.95% on three-month forecasts. They reached 56.68% on six-month forecasts. That is impressive. It shows that AI can extract signals from financial data. But an earnings direction prediction is not the same as a profitable stock trade. Markets can expect good earnings. A stock can fall great results. A stock can rise bad results. AI is also strong at organization. It does not get tired while reading a long filing. It can apply the same checklist thousands of times. It can catch a missing number or a changed phrase. What it cannot do is guarantee a future price. It cannot make uncertainty disappear. It cannot promise that yesterday's pattern will survive a new market regime. It also cannot change the fact that markets react. If a useful signal becomes popular, other traders can use it. The edge may shrink. Use AI as a research assistant, not an oracle. Let it help with the work. Do not let a confident answer replace judgment, diversification, or patience. The real answer is not yes or no. It is more useful than either. Can AI predict the stock market? Sometimes, in narrow ways, it can find useful signals. AMOM 111.6% gain and 34.3-point lead over its momentum benchmark show that AI-led strategies can outperform. But live, real money evidence does not show a reliable machine for beating the market. AIEQ's own report shows 9.60% annualized since 2017 against 14.73% for the S&P 500. Its $10,000 result finished far behind. QRFT once beat SPY by 11.7 points. Then it was set to liquidate. AIIQ liquidated in 2022. Those are not the marks of a solved prediction problem for a normal investor. The lesson is simple. Do not buy a promise because it says AI. Compare the full live record with a low-cost index. Check several time windows. Check the fees. Check the risk. Then ask if the tool is helping you process information or selling you certainty. AI can be useful. It is not a crystal ball. The report card is in.